This is Wallet Brief, where we cut through the noise and focus on what matters to your money. Stock market today has been one of the most searched phrases this week, and for good reason. The market just closed out its worst week since November, with the S&P 500 barely holding steady at 6,836 points, and the Dow finishing Friday at 49,503. But the real story isn't just the numbers, it's the anxiety driving them. The S&P 500 ended at 6,836.17 on Friday with minimal gains, while on Thursday, the Dow dropped 669 points amid fears that AI would disrupt whole industries. Logistics companies like C.H. Robinson saw massive sell-offs. Software stocks extended year-to-date losses, with some funds down 31 from recent highs, and even real estate took a hit on unemployment concerns tied to AI automation. At the same time, January's inflation report came in lighter than expected at 2.4 annually, which should have boosted confidence, but it didn't. The market is stuck between relief over cooling inflation and fear about what AI might replace next. Here's what's actually happening. The market is recalibrating around artificial intelligence, not just the winners, but the potential losers. For 2 years, AI hype lifted tech stocks. Now investors are asking the hard question: which businesses will AI make obsolete? Trucking, freight management, wealth advisory, even office real estate all saw sharp declines this week as new AI tools demonstrated real capability to automate their core functions. Meanwhile, Treasury yields dropped to their lowest level since 2022 as traders bet on more Federal Reserve rate cuts, signaling that investors think the economy may need support. If you have a 401k or retirement account, you probably saw red this week. The broader market declined, but the damage was concentrated in certain sectors. Tech-heavy portfolios took the biggest hit, while companies tied to infrastructure and economic growth held up better. The good news? Lower inflation means the Federal Reserve has room to cut rates, which could reduce borrowing costs for mortgages, car loans, and credit cards later this year. The bad news? Volatility like this tends to come in waves. Your account balance may swing before it stabilizes. Keep an eye on 3 things. First, any new AI product launches. They're now market-moving events that can tank entire industries overnight. Second, the Federal Reserve's next meeting in March. Rate cut expectations are rising, and that could shift market momentum. Third, earnings reports from companies in logistics, software, and real estate. If they can show resilience against AI disruption, confidence may return. The market isn't crashing, but it is adjusting to a new reality. That's it for today's Wallet Brief. Subscribe for daily updates on what's moving markets and your money.